I want to thank you all for coming. This is a webinar sponsored by Nelson Mullins. I've got with me my partners, Andy Tucker, Peter Strand, Wells Hall, and Sue Stoffer. Andy and Peter both specialize in kind of Spac transactional work, and Wells and Sue are the people you really want to listen to, which are the tax people who've worked on the formation process for SPACs and also on the de-SPAC transactions. Next slide, please. Next slide, please. We're going to cover today, in very quick fashion, in an hour, because we know how much you value your time. We're going to cover like the entire SPAC life cycle, and it's a very kind of cluttered set of slides we have, I would say, and informative. And so we're not going to go through each slide individually. We're going to instead go through the slides at a fairly quick pace. And I'm going to start off by talking a little bit about, the SPAC. The SPAC is a general proposition. Special purpose acquisition companies is a general proposition. And then Andy's going to talk a little bit about forming them. And then Peter and I are going to go through the de-SPAC process. And in between all of that, Sue and Wells will be talking about the tax issues. So to start off, what is a SPAC? It's funny. My wife was saying to me the other day, she's like, and what is that SPAC thing? Right? Because you hear about it all the time now. And it's almost like, oh, it's the hottest thing to talk about. And I might point out that the most recent articles haven't been too flattering or favorable. But I think that a SPAC stands for Special Purpose Acquisition Company. Some people call it Special Purpose Acquisition Corporation. And they raise money in kind of a blank check form. They raise money, they put it in trust. And then they have about 2 years usually to find a target company that wants to go public. Next slide, please. This timeline I like because it kind of lays it all out, and it saves me a lot of conversations with potential clients. Here you've got, the founders or sponsors group. They get together, they put in the money to kind of get the whole thing off the ground. Then they form the SPAC. Then the SPAC IPO comes, and all that money is put in trust. Then they go start their life as a public company, search for a target. They go get a shareholder vote in favor of that target, hopefully, and then they consummate the merger transaction. So we're going to cover all of that. Next slide. So, it's interesting. I get this question a lot. Why are SPACs so popular right now? And the knee-jerk reaction is, well, in a toppy market, you're going to have a lot of people interested in blank check companies just because, they can go out and find something and they can persuade people to give them the money. It's basically a sign of too much going on. But actually, there's two subtle reasons that are making SPACs very popular. One is it gives the opportunity for private companies to go public without an IPO. So it's an alternative to an IPO. Another is interest rates are low, so people giving you their money for a couple of years are not too, are okay with giving you the money because the opportunity cost isn't very great. There's no other place they could put it that would be quite so safe and still give them equity, and a little bit of a return and a chance for an equity upside. Next slide, please. I think it's important to put the SPAC in a broader context. The reason why SPACs are very popular right now is tied to the fact that private equity has become so predominant in our financial system. We have people who are, controlling companies in numbers like never before, private companies. And they also have a need for liquidation, at the end of the cycle of their funds. So after 8, 12 years, whatever it is, usually 8 years, the private equity fund that is taking control of an entity wants to realize some of the value in that entity. So they've got 4 options, really. They can sell to a strategic investor, or they can sell to a financial investor like themselves. A strategic investor would be like an electronic vehicle company selling itself to General Motors. A financial investor obviously would be another private equity firm. Then you could sell to a SPAC or conduct an IPO. Conducting an IPO is you sell a portion of the company and you retain the rest, but you dribble it out perhaps over time. A sale to a SPAC kind of falls between the sale to a financial advisor and conducting an IPO. It has a lot of advantages of an IPO in the sense that, you afterwards have a liquid security and you still can retain part of the company. So if you believe in its future, that's kind of good. And it has some of the advantages of selling to a financial investor. You have one entity to negotiate with, the SPAC, and when they give you a price, that's the price. Now that price is double checked by doing a pipe at the same time to get, market price correct. But when it comes right down to it, if you're doing an IPO and the night before people at your investment bank say, well, we really thought it was going to be $15 a share, but we're being told it's $13.50, you've suddenly lost a substantial amount of your, 15% of your value that you weren't anticipating losing. And a lot of people have gone through that process and not really enjoyed it. So they like the idea of dealing with SPACs. Next slide, please. I think that, some people are arguing, oh, it's a speculative vehicle that comes up at the end of a bull market. I think unless the SEC kills it through some sort of regulatory change, I think it's a structural change in how companies are going to go public. It's just for the reasons I described before, something people really appreciate being able to do, which is negotiate with one person. They also have some other advantages. Go next slide, please. We've covered this. One thing we didn't cover, go back, please, is use of projections. You hear a lot about this. There's been some SEC guidance recently, which has kind of shaken people's faith in the ability to use projections. But basically, when you're doing an IPO, you aren't going to put projections into an IPO document because there's strict liability for the projections that are put in there. In other words, you could get sued on them very easily. When you do a PIPE transaction, a private investment public equity, in connection with a SPAC acquisition, you can use projections in that context, and then also put those in your S4. And the SEC came out recently and said, well, that doesn't really qualify necessarily for the safe harbor for forward-looking statements, but there is a bespeak cautions doctrine that can be fallen back upon, and so projections are still able to be used, and it's one of the advantages you have in the SPAC process. You can use real projections and get those out to the public. Next slide, please. And it's important when you're looking at the alternatives of an IPO. IPOs, they dilute shareholders a lot or owners a lot, because a lot of times there's a pop on the first day, and the average pop over the last few years has been like 30%. So when you do an IPO, you're really not getting the price for your ownership that you should. I mean, if you retain some ownership, of course, that pop will benefit you. But the piece you sold off to the public, to the big investors, you're not getting as much money as you should for it. And that's one of the reasons why people think, well, it's not much less dilutive than an IPO, even though there are certain things that are special about SPACs, like the founders round and underwriter fees and discounts that are, a little bit different. Next slide, please. So let's see, is it a passing phenomenon? I guess we kind of covered this already. Next slide, please. Yeah, I kind of said this, some of the advantages of a SPAC. You lock in the price, you can use projections, direct negotiations. Traditional advantages of an IPO, there's no promote, less dilutive from warrants, no changes in board management. Next slide, please. And this slide just tells you how popular SPACs have become. I mean, they're just ridiculously popular. We've had a little lull here right now. We can cover why later, but there's more SPACs have been done this year than all of last year. Next slide, please. So these are a couple of recent issues that have come up in the context of SPACs, and I think that it's probably worth mentioning them, in this context. The SEC basically came out and said, SPAC warrants, which have traditionally been viewed as equity, are now viewed as derivative liabilities for accounting purposes. So all the SPACs are having to go out there and reconsider this particular fact, either change their warrants so they look more like equity, or restate their financial statements, or just change their financial statements so they show their derivative liabilities. I also mentioned this thing about projections. Next slide, please. This is just how a SPAC formation works for those of you who are interested. Basically, if you're going to do $200 million SPAC, you raised $6 million from friends and family, so to speak, from the founders. You form the LLC. You actually, in the beginning, just invest a fraction of the $6 million to get it going, but ultimately you'll invest $6 million in the SPAC through the LLC in exchange for 50 million units, and also those units will have shares and warrants in them. So the purpose of this slide is to give you an idea of how much the promote is. The promote is 20% on a pro forma basis of any IPO. So if you raise 200 million, it's going to be $50 million worth of warrants and shares. At the time of the IPO, the reason why you have $6 million is $4 million has to be paid to the investment bank when they consummate the IPO, and $2 million is used to run the SPAC. These are kind of rough numbers. They may be a little bit different depending on how big the SPAC is or what underwriter you have. This shows the basics of how an offering works. Units are always sold at $10. You know, the warrant coverage sometimes is 1-to-1, but recently it's been 1/3 of a warrant for every share you get in the units. The warrant exercise price is $11.50. The crescent, which is when the warrant exercise price gets adjusted, is usually like $9.70. The underwriter's discount is 2% at the IPO, 3.5% when the de-SPAC occurs. So that second piece doesn't go to the underwriters if a de-SPAC doesn't occur. And 100% of the IPO proceeds sometimes used to be 101%. In other words, the founders would have to put in even more money, but 100% of the IPO proceeds are put into the trust. Next slide, please. Basically, the SPAC has anywhere from 18 to 24 months with 6-month extensions to get their acquisition closed. It's important, closed. And there's redemption rights available to SPAC investors, which is kind of one of the key things. You know, you put your money in the blind pool, you can get your money out of the blind pool at the time of the consummation of the acquisition if you don't like it. So you don't have to sell, you can sell it into the marketplace, but you can also get your money back. You also get the opportunity to do that when an extension is being proposed. The redemption price is always $10 plus interest. Next slide, please. So I'm going to turn it over to my partner, Andy Tucker, to talk a little bit about the specifics of legal formation.
Right. I mean, basically, you know, the question of where you put the SPACs, I think every SPAC is either a Delaware SPAC or a Cayman Islands SPAC. It really depends, or British Virgin Islands. Really depends on where your focus is for your acquisition. Sponsors who are focusing on buying in the U.S. will generally use a Delaware entity. If you're looking at a foreign target, you will generally use the Cayman or British Virgin Islands, and that's just for tax reasons for your investors. More tax treaties, easier repatriation of capital gains. So, you know, most of our SPACs are domestic SPACs. They're U.S. SPACs, although we are doing a fair number of Cayman SPACs these days. Next slide, please. You know, SPACs have a finite life, as John said. It's, you know, up to 2 years to execute on. One of the things that gets negotiated now is, you know, how long you have before you have to complete the acquisition. You know, first-time SPAC funds in a somewhat choppy market are having slightly shorter life cycles, you know, 12 to 15 months with extensions as opposed to 18 to 24 months. You know, the trust account is basically just invested in, you know, effectively treasury securities to avoid becoming an investment company. The classes of equity, and this is, you know, one of the things, as you know, there was an article in the Wall Street Journal yesterday that kind of pointed out that, geez, there are different classes of equity and they get different rate of returns. You know, they're founders, and we're going to get into the carry and the promoters. John mentioned it earlier. The public stockholders who purchase in the IPO, the warrant holders who can be, you know, different than the stockholders as things trade. The accounting considerations of warrant as dead, which is a new one. It seems right now that everybody, you know, the market has been kind of frozen on the issue for pricing. There have been a few pricings since the SEC came down. Those all basically were deals where there were no warrants at all. Although today there will be several deals pricing with warrants and with liability treatment in the market. So that's a good sign that the market will kind of come back. You know, obviously, if there's no deal done, they have to redeem the shares. Each SPAC has, you know, goes out to the market with a industry. You know, you're basically much like a private equity fund. You're buying you're buying the sponsor's ability to find a successful deal. So the management section and the business opportunity are probably the most important thing for understanding what you're getting into. And the size, you know, 3, 5 to 7 times the size of the SPAC is the size of, you know, the de-SPAC transaction generally. Although obviously, something like Grab with a $35 billion size. It wasn't a $5 billion SPAC that was making that acquisition. Next slide. There are a series of voting restrictions and such that are in SPACs to preserve the rights of the stockholders and to, quite frankly, to limit the ability of the sponsors to drive some of the votes. And so, unlike a regular corporation where things are decided by majority vote, there are supermajority requirements, 65% for certain things, modify redemption provisions, and extensions and such that the SPAC will have to contend with, and that's basically to make sure that the public gets a chance, a significant chunk of the public gets a chance to vote on that sort of thing. The sponsor puts in initially $25,000, gets their 20% for that, and then they put up the rest of their contribution as the $6 million that John referred to, and that number varies significantly. And that buys additional either warrants or units that are identical to the ones sold to the public with some subject differences in the warrants. And
I think it might be worth mentioning here that, when you're trying to put together the SPAC, you're going to be looking at maybe getting money from other people. And at that point in time, there's all sorts of negotiations that go on that we aren't really covering here that relate to, getting people to commit to vote for, the transaction that's ultimately put before the shareholders, or commit to make an investment in the IPO, or commit to make an investment as a backstop investor in the PIPE. And when I say commitment, it's a very loosey-goosey kind of commitment. But those are things that are, negotiated at the time of the formation transaction with sponsors other than the original sponsor, the founders who are putting money in as part of that $6 million. And it's an important part of the process, but we're not going to go into much detail here. Andy, I think you should go ahead and you kind of flip through the next couple of slides and really hit them at the kind of the top so that we're able to get around to the other issues.
Next slide. Yeah, I mean, this is kind of really a very nuts and boltsy slide, but basically, it's the $25,000. There are some upfront costs to forming the SPAC that go obviously beyond $25,000, accountant fees, SEC fees, FINRA fees. So the sponsors typically advance a couple $100,000 in to cover the SPAC's initial advances. That covers against the shares that they will ultimately purchase in the SPAC founding. Next slide.
The important practice point here is to remember that when you're forming your SPAC, when somebody comes to you and says, oh, or if you're doing it yourself, oh gosh, how much do we have to get the SPAC off the ground before the IPO? The number, isn't very big. The costs of lawyers and the costs of accountants and the costs of a few other folks, setting up, the bank account and all that, it's not going to be more than like, $25,000 to purchase the initial securities. It's not going to be more than like $300,000. That's the only thing you have to come out of pocket for before you actually raise the money in the IPO. And the reason why I put it that way is not because at the time of the IPO, you take money out of the IPO to pay that $6 million, but because all the founders and all the sponsors actually don't write their checks for that founders round money, except for that $300,000, which is borrowed from the initial formation group. All that, the balance of that $6 million comes in right before the IPO. And that's important to know when you're negotiating to get people to put money in, because they aren't going to have to put money in until they're sure the IPO is done. So the only real risk money initially is that $300,000. Go ahead, Andy.
Yeah, let's go on to the next slide. This is, the audit mechanics. It's a very simple audit to get through. Obviously, you're talking about a company with no operations that may have been in existence for all of a couple weeks at that point. The sponsor will arrange for preparation of financial statements. They'll hand them to the auditor, and the audit will get done, and that will go into the S1. Next slide. The and this slide kind of addresses the some of the forward purchase agreements, commitments to purchase in the future. There's now discussion that those may constitute liability treatment as well. The changes in the warrant structure, and we're all analyzing that right now. At this point, any SPAC that's getting done, new SPAC that is getting done with liability treatment. I am not aware of any SPACs that have filed for pre-clearance to get equity treatment with the revised warrant. There is a revised warrant floating around out there, but the SEC hasn't blessed it as to whether it would get equity treatment or not. Next slide.
Yeah, this is pretty technical stuff here. We can skip this.
Yep, I think we already covered this. Next slide. SPAC, this is kind of a technical SEC type stuff. This basically deals with the fact that the SPAC is essentially a shell company, depending on certain requirements, and subjects it to certain ongoing reporting deficiencies or reporting requirements that a regular IPO candidate would not face. Next slide. And this is just more lawyer points about that. We can kind of skip over
this. Is really
time.
Yeah, this is a really good slide for issue spotting for you lawyers on the phone. I think that it's, to kind of sum up the whole formation process, it really is as simple as it seems in some respects, but there are some little tricky turns here and there. It's a company that's just got cash in it and that has a formation vehicle, the LLC, the sponsor, and then, you create the SPAC, and then you employ professionals, and then you look for money in the public markets, and it's very straightforward if you've ever done anything like a blank check company before, except it does have a few nuances. The next slide, I think.
To the next slide. And that goes over to Sue.
Yeah, Sue Stoffer, if you could, was recently quoted in the press today on these very issues. So if you could just kind of run us through this, that would be great. And I think you can take a few minutes because I know people want to hear this.
Right, I can. On the SPAC formation side of the equation, where the executive comp issue comes into play is what money the sponsors are using to invest. All right. It's been a rather hot topic in the press these days that isn't it wonderful that you can use your IRA funds, or even better, your Roth IRA funds, to do that investment as a founder. The thing to watch out for there is that when you're using an IRA fund, or in particular a Roth IRA fund, to do any type of investment in an entity, and you are the fiduciary of your IRA, you've got to be careful and look at any potential prohibited transactions. All right, and the reason you don't want a prohibited transaction is because if the transaction involves a prohibited transaction, then you look back at the beginning of the year and you disqualify your entire IRA. It no longer is tax exempt. Your IRA is taxable as of the first day of the year. You value the fair market assets as of the first day of the year. And to top it all off, the IRS slaps you with an additional 15% excise tax on the amount that you used in your prohibited transaction. So it's a horrible result. So you do need to be careful before you head down the path of, gee, if I use my Roth IRA funds to invest, therefore all my earnings coming back through my Roth IRA are tax-free, at least under current law. Yes, that would be wonderful, but make sure you're not inadvertently walking into a prohibited transaction. For example, if you were in a situation where, as a founder, you also are somehow going to receive some type of other compensation for managing or doing any other type of W-2 type comp for the SPAC, then no, that would create a prohibited transaction situation. But probably the most common one that I see is that an individual wants to buy in and decides to use cash from their Roth IRA to buy in for a portion of, let's say, their $25,000 buy-in, and then the rest they fund out of their own cash. Well, that can lead to an inadvertent self-dealing prohibited transaction. So, it's very fact specific. You've got to look at the situation. You typically will fall within an exemption and not have a problem, but it is an exercise that is well worth your while to go through before you use an IRA, or in particular your Roth IRA, to do any type of sponsor investment here, because you do not want to walk into a prohibited transaction penalty situation.
Yeah, that's very helpful, Sue. And I will say, in the real world, this comes up all the time. So it's an important practice pointer. It's also an important pointer for those people who are considering creating a SPAC. Next slide. So for the next about 20 slides, we're going to be talking about the de-SPAC process. And the de-SPAC process is a fancy way of saying the SPAC acquiring a target. And, de-SPAC process makes it sound, oh my gosh, it's very mystical. For the SPAC itself, it is a de-SPAC, but that's the least of everybody's concerns. The real thought here is, the real thoughtful thing that's happening here is companies going public through being acquired by was a shell company that's already a public entity. So the surviving entity usually is the SPAC because they're already listed and they're already traded. So we're going to walk through some of this at a high level, so you can review it yourselves through the slides later on. But we're going to walk through what goes on in de-SPAC transaction, and I think that the most fundamental level, it's just public M&A. Next slide, please. So this is kind of an elaborate list that somebody put together, which I think is good, related to the de-SPAC process. We get a lot of questions, and I'm going to hit these very quickly. So we have identifying targets, signing a letter of intent, sign the definitive merger agreement, raise funds in a pipe, secure financing, file Form S-4, hold SPAC shareholder vote, consummate the acquisition. Now, for those of you who have ever been in a transaction in the public realm, a lot of this will look very familiar. There are a few things that I would kind of, flag for you with respect to the de-SPAC process. Identifying targets. I think that I've had probably 100 conversations where people come to me and say, oh, well, I've identified a company I want to buy. How about I raise money and SPAC for that? Well, that's not allowed. Basically, there's a problem concerning the disclosure, as you might expect, that you're making to the IPO purchasers. The purchasers in the IPO, if they knew you were buying a certain company, they would want to know that, before they actually put their money in. So, it's important that if you have a process in place, even before you go public, that you're very careful about, quote unquote, identifying targets, that you aren't actually having conversations with them about how much money they would accept if you did have a SPAC. The other thing I would flag, the next thing I would flag is on this letter of intent. The letter of intent doesn't just cover the traditional things letters of intent cover in public acquisitions, like the consideration or the earnout or things like that. They'll also cover, if any part of the promote, which we discussed earlier, is going to be held back. Definitive merger agreement. I think that's important in this context to know it's a big signal of how things have gone. It's publicly announced. I guess we'll get to some of this in the next couple of slides. Let's go to the next slide, please. This is of interest, and I'm going to walk people through this very quickly. People say, well, the SPAC process is so odd. How does that actually work when you do an acquisition? Well, what happens is you find a target. So let's say you have $600 million in trust from your IPO. In that case, as Andy said, there's going to be, anywhere 3 to 5, maybe 7 times as much. This is a little bit of an old slide because we're showing you an older transaction. But, maybe it's a $2 billion company and you have $600 million in trust. Well, you've got to raise another $550 million in a pipe in order to get that done. So on the backside, what you have is for capitalization, you have $600 million will be owned by the SPAC shareholders. $150 million will be owned by the SPAC founders. $550 million will be owned by the PIPE investors. $1.75 billion will be owned, and when I say be owned as shares by the target shareholders. In other words, this assumes that there was, they were just rolling everything. So they took equity. The target shareholders took equity in the SPAC in connection with this transaction. Next slide, please. So this slide is from a presentation that was filed with the SEC for Spartan Energy Acquisition Corp. so you can go and find this publicly. And this sets out, that's where I took that example from. The important takeaways here are that a lot of times people in the target company are asked to roll their ownership, and every de-SPAC involves a PIPE, because that's what prices the deal. Next slide. Peter, do you want to cover this?
Absolutely, John, thank you. So this slide gives a little bit more detail to the steps to the de-SPAC process. Once the SPAC completes its IPO, it begins the process of identifying targets and completing the business combination. It has 18 to 24 months, depending on the life of the SPAC, to find and consummate a business combination. And once you find a target and identify a target, enter into a letter of intent, the process to close, which is entering into a definitive agreement, getting the shareholder vote, and then actually closing on the transaction, can take anywhere from 2 to 5 months, which is timing-wise very similar to an IPO. The first step is identifying a partner. As John said, you really can't, for securities laws reasons, have identified the partner before you complete your IPO. So once the IPO concludes, now it's the management team's job to try to find a partner. The source of that can be industry contacts, sell-side investment banks, vendors, law firms, and any kind of referral network that you may have. And that's really where the management team earns their money.
Yeah.
Once you negotiate,
Peter, you might flip to the next slide, because that's covered there.
Yeah, I got it. I will. The next step, once you complete the LOI and identify target, you begin negotiating the definitive agreement and entering in the due diligence. They also begin the PIPE process to identify PIPE investors and begin preparing the proxy solicitation materials and the S4 registration statement, if there is one. The next step is to execute the merger agreement, announce the transaction, execute PIPE documents, and cleanse the PIPE investors. Then you begin the process of filing the proxy statement and clearing SEC comments. Once you do that, you mail the proxy and you begin soliciting proxy votes, getting the votes for approving the transaction. But also, there's a marketing process that begins to reduce the number of redemptions. Oftentimes there's a redemption limited. There's a limitation on how many people can redeem in order to conclude the transaction. Finally, the closing. So move on to the next slide.
Yeah, go back to the previous slide just for a minute. Just considerations. I want to flag a couple of things for people here when you're working on identifying target companies. I get questions all the time about, oh, well, I'm a big asset manager. We have some portfolio companies. Can they be targets? The answer to that is yes. It just has to be handled correctly. We did the megalith acquisition of Bank Mobile, and both those entities were controlled by the chair of Customers Bancorp, and that required some elaborate corporate governance precautions. But ultimately, it got done, and it can get done, which I think is good news for a lot of the asset managers who are in the space. I also would flag that, IPO underwriters and the people who are going to be helping you in that process really should be a source of possible targets as well. I don't think they're probably going to know the universe of targets as well as the management team does, because that's what the management team is getting paid for. But they should be providing you some guidance. Anyway, next slide.
Yeah, we should. I also want to point out it's important to keep a detailed record as the management team, to keep a detailed record of who you talk to. This will have to be disclosed in the S4 or proxy statement once you prepare that. So know who you talk to, know what NDAs you entered into, and how far along in the process you got with each party. And then once you identify the target, you'll have to give additional information on them and who your advisors were in the process. That's a particular focus of the SEC and also of shareholder litigants. And then, as John pointed out, you'll want to consider conflicts of interests with underwriters, sponsors, advisors, and the target. You may need to engage a special committee of the board to analyze conflicts, and then also you may need a fairness opinion. although commonly in SPACs, there's no fairness opinion. Next slide, please. As with all M&A, you need to consider the target, consider the quality of management and its systems, ability to create a financial market that you'll need for the marketing materials and also the S4 or proxy statement. Consider how usable the projections are and how to kind of check those down. And then consider whether the target's going to be able to ramp up and become a public company rather quickly. That will involve audited PCAOB compliant financial statements, staffing, reporting, legal, and as Sue will explain later, the employment comp and benefits issues will need to be discussed as well. Next slide, please.
There's a couple of practice pointers before we leave, about that last slide. It's really important to view any target as you would view a company you were going to take public in an IPO. And by that I mean, the management team just doesn't have to just be high quality. They have to be, people that can be in a public company without any, for instance, embarrassing facts in their background. The SEC requires disclosure of certain things like bankruptcies or problems with the securities industry, but there's other things that come to light during the process of taking a company public that would normally be handled in the context of, before we go public, we're going to make sure we've got our house in order. With the de-SPAC transaction, it's a little bit more difficult to make sure that happens, because the entity that's public, that's well aware of these sorts of problems, isn't the entity that's going to survive. The management team isn't going to survive, generally speaking. It's the target's management team that's going to survive. So any HR issues that might be embarrassing, any kind of just general criminal law, drunk driving issues, that sort of thing, sounds pedestrian to mention, but you'd be surprised how many people decide they don't want to get involved with a public company because of the disclosure that would be embarrassing. Another thing is people sometimes lie about their education, and that comes to light. So all those things have to be carefully considered when you're deciding whether or not you, if you're a SPAC, or whether or not you, if you're a target, want to be involved in a de-SPAC transaction with an entity. Go ahead, Peter.
So as a private company, the target likely does not have PCAOB compliant audited financials. They'll need to prepare those in connection with the business combination, and that takes some time and effort. So the requirements are the same as you'd need in an IPO, 3 years of financials. You also should consider, this is the next slide, whether you'll need additional financials of a joint venture or recent acquisitions that require historical or pro forma financials. You also need to prepare pro formas for the as combined de-SPACed company, and oftentimes we'll need a consultant to prepare those. And the target will be preparing an MD&A, quite possibly for the first time. That's management's discussion of their results of operation and their business. And oftentimes, the target company's CFO is not prepared to do that or has never done it before, and there's certain art to it. And then also you'll be preparing rigorous due diligence. Both parties will, but for this newly public company, we'll need to have all their affairs in order, as John discussed. The next slide.
Go to the next.
The next slide identifies some of the additional considerations. The major ones are the time pressure and the financial pressure. You only have a certain amount of time to get the business combination consummated, and there's also always a rush to get through the SEC and get the meeting and approval. Some additional considerations on the next slide include the risks if the process goes bad. There's rarely a termination fee, and on the SPAC side, the money of the SPAC is protected in trust, but the time that's lost in a failed transaction and the public exposure is often fatal. And there's emerging litigation risks. The plaintiff's bar is taking a more and more active role in SPACs because they are public and they are visible, and it's the kind of the hot item right now.
So there's a practice pointer in that last one. When you go public, you're going to get D&O insurance, so directors and officers insurance, and the rates for that have gone sky high. So if you're doing a de-SPAC transaction, you might want to keep that in mind. These next three slides I'm going to go through very quickly. The letter intent process is very similar to the one you would go through in any public acquisition. Setting up the terms and the structure and the pricing. The only thing that's probably worth mentioning is usually rolling the having the shareholders in the SPAC retain a significant portion of the consideration is usually something that's a goal. Let's go to the next slide. It's important to remember that, so you have a stockholder approval requirement for the SPAC, but that's pretty straightforward. There's a redemption opportunity for SPAC stockholders at the time, and then there's restrictions on post-merger on stockholders under the securities laws and regulations. Basically, founders are going to be tied up for like a year. And finally, there's an interesting thing about SPACs that's probably worth pointing out is when you do a public company acquisition of another entity, it's usually the case that if it's a private entity that they'll have maybe an earnout or something like that. Actually, the things are flipped here, which you'll sometimes see is an earnout for the founders of their promote based on the performance of the stock on the backside of the de-SPAC. So it's an important thing to identify that a lot of times the indemnification effectively works the other direction. Next slide, please. Sometimes there's a minimum cash consideration. Also you're gonna have reg rights for sponsors. I'm gonna go to the next slide. So Peter, why don't you touch on the high points here about drafting an acquisition agreement?
Yeah, the acquisition agreement is very similar to a large M&A transaction, although there are some special considerations for SPACs, namely that there's oftentimes a minimum cash consideration condition, like John mentioned, that will affect your level of redemptions. It will affect how large the pipe is and how many people are involved in the pipe. It may require debt financing or some sort of backstop investor. And so next slide. As well as we'll discuss later, the major consideration in these definitive agreements is structure. Those are oftentimes tax motivated. Oftentimes you see a reverse triangular merger or some sort of Upc or special structure based on tax. The consideration is usually more often than not all stock, although you do see some combination of stock and cash. Next slide. As John mentioned, oftentimes there's an earnout for the target's shareholders, but there may also be some sort of quote earnout for the sponsor where they take some of their founders' shares and warrants and subject those to forfeiture based on, or forfeiture or vesting based on certain performance conditions of the as combined company. Next slide. This covers kind of the considerations, oftentimes forfeiture or vesting that I just mentioned, and also the minimum cash consideration.
I think we'll flip through these next few slides quickly so we can get the folks to, this talks about lockups. It's important to focus on. Next slide, please. Board of directors, this is pretty standard stuff for those of you who do public company M&A. Next slide, please. Next slide, please. These are just some other deal terms you guys can review on the backside. There's voting agreements, there's support agreements, lockup agreements, reg rights agreements. It's pretty standard fare in this kind of context. Next slide, please. This is important. Peter, do you want to cover any of this?
Yeah. So
go ahead.
No, go ahead, John. Sorry.
I was just going to say, it's basically when you do the PIPE and then you have the announcement of the PIPE and the M&A transaction, you have a period of time that you've got to file the S4, and during that time, the market, you're going to be vulnerable to market movements. So there's kind of a typical roadshow put together in connection with it, and projections are used. And those kind of market communications are handled usually by a professional that's a little bit different than the IPO context, though you see those professionals more in IPOs than you used to. And it really is kind of a different look and feel than you normally associate with an M&A transaction. So it's important to kind of keep that in mind. Next slide, please. This is about the shell company status. I'm going to skip over that. That's a practice pointer for practicing lawyers. And I'm going to turn it over to Wells Hall to talk about the tax consequences in de-SPAC transactions.
Thank you, John. For the first 45 minutes or so here, John, Peter, Andy, and Sue have talked about the securities law, the accounting, the corporate governance, and the executive comp aspects of forming a SPAC and then acquiring a target company. The next few slides are going to deal with some of the tax issues that are raised. Andy mentioned the choice of a domestic or a foreign entity to serve as the special purpose acquisition company, and that generally, as noted on this slide, depends on where your target is. If you know you're going to acquire a domestic target, it's likely that you would be better off forming the SPAC as a domestic entity. And much of that is because if you bring a foreign SPAC into the United States, in other words, you domesticate a foreign SPAC, you create tax leakage. And tax leakage means that either the shareholders or the SPAC itself are going to be exposed to certain taxes under the foreign personal holding company, personal foreign investment company rules, and the inversion rules that the United States has created to discourage investment overseas and domesticating foreign companies or creating foreign companies and bringing them into the United States. We're going to move forward to through the next couple of slides to get into the actual acquisition of the target company and some of the structures there in light of our time limitations. Please, I think this moves on to slide 58. Now, what type of companies do we see being acquired by SPACs? Please move on to slide 58. Basically, we see S corporations. We see C corporations, which have been formed by their owners as qualified small business corporations, which qualify for zero income tax on the first $10 million per shareholder. Now, those companies have to be formed under 50 million of capital. So they start out small, they grow, and then they're acquired by a SPAC. We see companies that are held by private equity funds as portfolio companies. I think John mentioned that. We see limited liability companies that are taxed as partnerships. And sometimes we see a division of a public company. John mentioned the Customers Bank Mobile transaction. In all of these situations, the tax issues have to be considered in deciding what structure to take in acquiring the target organization. These can be either tax-free or taxable transactions. Most M&A lawyers are familiar with acquisitive reorganizations, where you acquire a target company in a non-taxable treatment. In other words, you issue your stock for their stock and end up with the rollover component of the stock that's moved from the old company into the new company, in this case the SPAC, as being held without subjecting to tax. You can sell the stock down the road when you decide to sell it on the public market, perhaps after the stock has gone up substantially in value and realize more gains. This slide lists a number of those acquisitive type reorganizations. In all cases, the tax-free organization means that the target company is going to have the carryover basis for its assets. There's going to be no step up or increase in the basis of the assets for the SPAC after the transaction. The next slide shows the corporate merger under, we call it a B merger, where the SPAC either merges into the target or the target shareholders and receive stock in the SPAC. The next slide, the A2D merger, where the target merges into the sub of the SPAC and the target shareholders receive stock in the SPAC or cash. And in these transactions, there's always a limit the rollover shareholders have to maintain at least a 40% of the consideration received by the selling shareholders has to be stock in the SPAC. They can take up to 60% cash or other consideration. Next slide, a similar transaction I've often seen. This is where you have the SPAC merging into the target company, so the target company survives. Again, you've got some of the same considerations. You have to maintain substantially all of the assets as assets of the SPAC. The next series of slides talks about the types of transactions that we have seen on a more regular basis as a result of the interest in most shareholders of getting a lot of cash out of the transaction. In each of these Section 351 transactions, there's no continuity of interest requirement. In other words, you don't have to roll over 50% or 40% of the consideration in stock. And in each situation, it can be part taxable and part non-taxable. The first one, let's talk about the double dummy. This has been made famous for many years, but the two dummies are at the bottom of the screen, and you'll see that the SPAC merges into one subsidiary from the right of your slide, and the target merges into the subsidiary on the left of your slide, and there's a new surviving public company. And basically, it's a continuation of the SPAC, and the shareholders in the public company now own shares in the surviving public company. Next slide is a Upc transaction. You've probably heard of Upc transactions where the target is a partnership, and the goal here is to give the selling shareholders some of the tax benefits that derive from their selling their shares on the market, either currently or contemporaneously with the de-SPAC transaction or down the road, and they end up getting, through a tax receivables agreement, payments that can last to 15 or more years, resulting from the tax benefits that are derived from the additional basis that the inside assets have, which can be amortized as goodwill or depreciated by the SPAC. So there's benefits for both parties, and the selling shareholders participated usually into the extent of as much as 85% of those tax receivables. We've done all of these transactions. We are used to making the decisions up front as to how to structure these SPAC transactions. The executive comp benefits or executive employment benefits are very important here, and I'll turn it back over to Sue to wrap it up.
Okay, thank you, Wells. From a de-SPAC transaction standpoint, let's start by looking at the process in and of itself. And as John and Peter and Andy have mentioned before in this webinar, the de-SPAC process for the target corporation is similar, if not identical, to a company going public and that whole IPO process. But what happens with a de-SPAC transaction is that your timing is accelerated to a point where you may have had an opportunity before you IPO for a year in advance to actually look at your executive compensation, to do some planning, to do some analysis. With the de-SPAC transaction, that time period is sorely limited, in many cases to 6 months. In some cases, I've seen 3 months. That's a lot to do in a very short period of time. Some key items that you are going to need to do, though, is that the target company will need to take a look at their outstanding equity grants. I would bet you that most of your executives think that a de-SPAC transaction is just like any other change of control or liquidity event, which will result in any outstanding equity grants, RSUs, options automatically becoming fully vested. Not so fast, because when you look at your plan documents and your grant agreements, it is more likely than not that the definition of change of control or liquidity event only deal with a change in ownership of more than 50%, whether it be assets or stock. So a de-SPAC transaction is not going to fit, more likely than not, into your definition of change of control or liquidity event. So is that something in advance of the de-SPAC closing you want to do as far as an amendment to your existing equity grants? This may be something that is extremely desirable for an entity that thinks they may become a SPAC target at some point in the next year or two. Take a look at how your plans and how your grants are structured. Is this something that you want to take care of now, well in advance? Because once you're into the discussions with the SPAC, you won't be doing anything without a conversation with the SPAC itself. And you won't be doing anything without a particular eye to what the SEC disclosure is going to look like for any types of amendments or modifications that you're making to your plans or grants. So you do want to take a look at this and see if you would automatically already accelerate vesting or settlement, or if you want to. If you do want to do that, then you need to be very careful with respect to any options that were granted at a discounted exercise price. Discount options are subject to Code Section 409A. Code Section 409A is a code section which deals with the tax treatment of non-qualified deferred compensation. It's manageable, but there are a set of rules that have to be dealt with. And if you are non-compliant, the hit is on the executive. It's on the participant, him or herself, and it's a 20% excise tax on the amount involved. All right, not a great result. So you do want to be careful if you're looking at accelerating vesting or in particular settlement of a discounted option. You need to take a look at whether or not you can do that, or if it would trigger a bad 409A result. You also need to be careful with respect to RSUs. Okay, for restricted stock units, although many can be designed to be exempt from 409A, many will also be subject to 409A. And again, it's the same issue. So if we're talking about accelerating at the time of the de-SPAC transaction and modifying an existing grant to do that, we need to be careful of our 409A. The other thing we need to be careful of is to take a look at a 280G situation. Now, Code Section 280G, otherwise known as the Golden Parachute Rules, deals with a change in control that then results in an acceleration of payments that are contingent upon that change of control occurring. And if those payments, if the value of those payments exceed a certain amount, it's generally a multiple of average base pay, then the individual, again, can be taxed at a 20% rate, a 20% excise tax, and the company loses its deduction for the amount of the payments made. Not a great result. So what you want to do when you're looking at the 280G situation is you may think, well, 280G deals off of a change of control. Change of control is more than 50% of a change. My de-SPAC transaction is likely, in almost all cases, to be less than 50% change in ownership, so I shouldn't have a problem. Not necessarily. There is a third flavor of change of control solely for 280G analysis purposes that deals with an effective change of control, and that presumption is at a 20% change in ownership. All right, and de-SPACs are going to hit that 20% amount. So you are going to have to go through this analysis. You will more likely than not be able to rebut the presumption that it is a parachute situation, but you will need to go through that analysis to make certain that that is in fact the case. Lockups, as John has mentioned before, when we're dealing with equity, our primary principal officers will not be able to dispose of any equity that gets accelerated for a period of time, usually at least 6 months following the de-SPAC transaction. Other things that the target needs to be doing is the preparation for becoming a public company. You've got to identify your peer groups. You've got to set your compensation committee with independent directors. You need to look at design considerations for grants to be made at the time of the de-SPAC and thereafter, and how to deal with outstanding grants as well. You've got to look at those design considerations both from a short and a long-term perspective. You've got to look at all of this with an eye to how it's going to play from a disclosure standpoint. Remembering that we're not trying to be overly greedy here from an executive standpoint. Potential investors are not going to want to see all of a sudden, all of the equity being able to be cashed out and could potentially have an impact on the value of the company. 162M, Code Section 162M, you may recall, deals with the deduction for executive compensation. Historically, it was capped at 1 million, but there was a performance-based exception to that, that almost all stock options and other types of equity grants fit into. That changed with the Tax Act of in 2017. That performance-based exception was eliminated. Therefore, you've got a $1 million cap on your deductions for any type of compensation paid to certain officers, primarily your PEO, your principal executive officer, your CFO, and your top 3 highly paid individuals, officers beyond those two. In 2026, under the American Rescue Act, which was just passed into law a few months ago, that number will expand to an additional 5 people. So you'll be dealing with 8 altogether. And that will take effect in 2026. Nothing you need to worry about right now, but from a planning situation, going forward, once someone is a covered employee and identified as such under 162M, then they are always a covered employee, whether they change their designation and they're no longer fitting into your covered employee, PEO, PFO, top 3, or they retire. Any compensation received at any point in time, once you're designated as a covered employee, will be looked at for this $1 million deduction situation. So it is something that you want to be cognizant of, you want to take a look at, and make sure that any types of planned accelerations, et cetera, take this into account in your planning. One other thing to mention here is that an attractive thing for our DSPAC target to do is at the time of the DSPAC to roll out an ESPP, an employee stock purchase plan under Code Section 423, which can provide great incentive for the rank and file employees. What an ESPP does is it permits your employees, and generally all employees are eligible, to purchase shares at a 15% discount. And if all the rules are met, then when those shares are purchased and held, there's no taxation. But when they are later sold by those individuals, if held for an appropriate period of time, they will receive capital gains treatment, assuming that we still have capital gains treatment at that point. It can be a very attractive thing to get your employees involved in the whole DSPAC process, and everyone feeling like they're playing on the same team and all after the same reward, the growth reward. So those are some of the key highlights. The executive comp piece is complicated. It's time intensive, and we've got very little time to do it in a DSPAC transaction. So it's an all hands on deck situation.
Thank you, Sue. That was very, very helpful. We've come to the end of our hour and then some. We can entertain questions if you'd like. I don't know if we had any that were sent in. But I think that we'll probably just wrap up. I would say, as kind of an overview, that if you've been involved with public M&A before, or if you've been involved in taking companies public before, 80-90% of what you need to know about the process that is the SPAC IPO and then the DSPAC. I would also say, though, that it's a little bit like what they say about the English and the Americans. They're two peoples separated by a common language, right? So things that you think are going to work a certain way in the normal IPO context, the normal acquisition context, don't necessarily work exactly like that in the SPAC IPO context or the DSPAC. So on that note, I think I want to thank all our panelists and thank you all for tuning in. We really appreciate it, and please feel free to contact us if you have any other questions.